Buongiorno, sono Riccardo Esposito, sono il promotore di questa quinta edizione del Lugano Fan Forum e vi do il benvenuto. Una comunicazione di servizio, invito i delegati che si sono seduti presso le ultime file, se volessero avanzare. Le prime file sono dotate anche di un dispositivo di votazione, in quanto sarà anche organizzato durante questa conferenza una votazione, un'iterazione con il pubblico, ecco, qui pertanto potrete tutti in questa maniera partecipare. Adesso però ci tengo a presentarvi una persona, vorrei dire un personaggio che mi sta molto a cuore, in quanto il professor Salvatore non è soltanto un consulente del Fondo Monetario Internazionale o un advisor per l'ONU, ma è anche divenuto ormai da un paio d'anni un po' il direttore artistico di questo Lugano Fan Forum e mi assiste durante l'anno per organizzare il programma e portare a voi tutti anche personaggi illustri. È quindi con grande piacere che vi presento il professor Salvatore. Grazie.
Grazie. Thank you, Riccardo. It's a pleasure to be here today. I almost went away. I'm not a Nobel Prize winner, but nobody was here, Riccardo, to introduce me. Anyway, what I will do today is examine why slow growth. Is it the legacy of the global financial crisis? And then the growth prospects in advanced countries and the other G20 countries, that is the largest dynamic countries. Why is growth so slow in the United States and slower in Europe and Japan? I know that these are some of the things that Professor Stiglitz discussed this morning, but this is a slightly different view. Then slow growth in China leads to crisis or led to crisis in emerging markets. And finally, will China's slowdown trigger the next world recession? Something which will be the roundtable of tomorrow. First of all, I always like to begin as to why often policies or views are completely wrong. And this is not said afterwards. These are gross mistakes which cause really serious economic problems for the world, which could have been and should have been avoided, and which we indicated that they could be avoided. First of all, what do we need to do useful economic analysis and useful forecasts? There are three things that are needed. First of all, a deep knowledge of theory. Theory is like the GPS. Without the GPS, without theory, we navigate in the fog. We have no direction. Then you need to know the real world, because very often the real world does not operate as theory postulates. In other words, theory may indicate the effect of a policy, but if we do not know how the real world operates, we may make a very gross mistake. And then we need a little common sense. And if one of these things are missing, we make really serious and harmful mistakes. Again, mistakes announced, indicated before they occurred. And we have some examples of these mistakes and why they've been made for lack of one or more of those things. You see, economists think that they are pure scientists, that economics is like a natural science, like physics. But economics is a social science. But they feel that being pure theorists, they need not dirty their hands dealing with the real world. And so this can be the cause of mistakes. Then there are the business economists who either never knew the theory or have forgotten it, and so they extend trends even when there is no reason to do so. They are not justified in extending trends. For example, we had a crisis every 5 or 6 years, so technically we should have a crisis again now, but one could not think in those terms. And then there are people who know maybe both theory and the real world, but they really have no common sense. And we have some examples. The tree is grown crooked. There's nothing to straighten it up. And so we have mistakes. For example, Greenspan, which was regarded not by us common mortals, but by the other central bankers as the maestro, the best of the best. In the year 2000, was ruminating, because he often talks to central bankers to talk in a sense not very clear. Otherwise, every time he talks clearly, like Duesenberg did for the European Central Bank, causes a problem. So they have to talk, but they have to talk not very clearly or understandable. Well, in the year 2000, Greenspan, from what we could understand, was concerned that the United States was facing hyperinflation, when, again, we were already at the threshold of a new recession. So I told him, Mr. Greenspan, I think you do not understand globalization, because if you did, you realize that globalization is the most anti-inflationary policy the world has ever seen. A firm increases prices, it loses its markets. Workers demand and receive wage increases in excess of productivity, and the firm goes elsewhere. In fact, even though the price of primary commodities, petroleum in premise, shot up, we have no sight of inflation. So Greenspan really did not understand this revolution, which is globalization. Then we had Bernanke, his successor at the Federal Reserve, at the head of the Federal Reserve. He was asked in 2006, are we going toward a new financial bubble with housing prices increasing so rapidly? And he answered, no, this is the market working. That is, the demand for housing increases in relation to supply, and so the price rises. But Mr. Bernanke, if something increases at 10–15% per year, we know it's not sustainable, and it will become unsustainable. Last year, we had Trichet as a guest. We don't want to insult him, but he increased interest rates in April and July of 2011, when Europe was facing recession. And he said, in explaining why he was increasing interest rates to avoid inflation, and the fact that Europe was on the trajectory of increasing growth. And even if the rest of the world fell into recession, that Europe was large enough, the Eurozone, large enough, autonomous enough, that it would not be affected. Obviously, he had not understood interrelations, that we are in one closed system, and if one major part of the system is in trouble, it will lead to troubles also elsewhere. But we don't want to end with Greenspan, Bernanke, and Trichet. We can come closer to us, even what Joe Stiglitz said this morning. In order to restart growth, we have to spend more. Well, after the analysis, you judge whether that could be a solution to grow more. Well, in order to understand where we're going, we have to see where we come from in order to evaluate what to do next. And we saw that the recession, of course, started in the United States. But the United States real GDP declined by 2.8%, but then growth resumed. A growth which is not very high, we know, 2.2 on average, 2.4%, and Europe and Japan would be delighted by this rate of growth. But in the United States, as we will see, this was not appropriate, not adequate, and it should have been better, as we will see. Europe went into crisis deeper than the United States. Then there seems to be a recovery, a growth in 2010, but afterwards it went down, growth declined, anemic, and then recession again in 2012 and 2013, and even now the growth is limited. And have you noticed one thing? The forecast is always that this year we're not growing too much, but next year, it's always next year the growth is higher. But maybe hope eternal spring. We like to be positive optimists, but we also have to have, it should be tempered by realism. You know, we cannot dream what is impossible. Now, Japan is in deep trouble, the same as the United States. Can you imagine a country which in the 1990s seemed to be ready to conquer the world, had 6 recessions in 20 years, and the only major country that grew less than Italy, and we will say more about that. But the UK and Canada grew more in the range of the United States. The Anglo-Saxon countries, for whatever reason that we will indicate, seems to grow faster than the others. And it's not because of greater stimulus. We will see the reason. And this we see in this graph, we will see those negative bars indicate the decline in growth, the recession, the depth of the recession, greater in Europe than in the United States, and even greater in Japan. Well, I, of course, was born in Italy, but I live in the United States in more than 50 years. All I can say is that, yes, the crisis started in the United States. But if Europe had not committed even more excesses, as I will indicate, than the United States, the crisis would not have come to Europe so quickly, the financial sector, and so deeply. Now, one of the indications of the greater excesses of Europe can be indicated by the leverage. The leverage, as you know, is an index that goes from 0 to 100. A leverage of 0 means no possibility of a crisis. A leverage of 100, surely we will have a financial crisis. Well, the weighted average of the leverage for the 12 largest banks in the United States in 2008 was 20, from 0 to 100. For the 12 largest banks in Europe, which included, of course, Deutsche Bank and also UBS, it was 35. So, greater risk, dangerous risk by European banks and American banks. Then there was the housing bubble. Well, it was much higher in Ireland, in the UK, and in Spain than in the United States. So when the crisis came quickly and deeper in Europe. Then the crisis went to emerging markets, but this time they were not at fault. It came through the real sector, thus with a lag, because in 2009, at the depth of the recession, real GDP declined in the world, real GDP of the world declined by 2%, while trade declined by 9%. So advanced countries and going into recession started to demand less imports from emerging markets and invest less in emerging markets, and so the crisis spread to emerging markets. And so we see that the growth in China declined, but everyone is an expert on China now. I've been going to China since 1986 for 5 weeks a year. The leading text in China is my text in international economics. Of course, they copied without giving any royalties until now, but that's another problem. The leading text in managerial economics and microeconomics are my own. Of course, one could go to China and not understand China. However, when China was growing rapidly, we were told that it was impossible that a country could grow so rapidly. Well, my professor, the great Nobel Prize winner, the father of econometrics, Lawrence Klein, and myself studied China. If anything, it was growing faster than the official data indicated. Well, then, about 4 or 5 years ago, I started to say many of the forces that led to such rapid growth in China are becoming less operational. And therefore, I predict that the growth in China will decline to about 7%. I almost became the enemy of China, and no one believed. And of course, now we see that. And 2 or 3 years ago, I started to say, actually, the growth in China is not 7%, but much less, 4 or 5%. Again, now there are people who come afterwards. You see, in economics, in business, we play ahead of the game. We have to anticipate, not afterwards. Afterwards, we all know, and the market has already taken advantage of the new knowledge. The winning business and economy are the ones who anticipate. So we will see that the growth is much less. Then we are told, well, the growth, even of 4 or 5%, is double the growth in the United States. But the growth in emerging markets needs to be measured differently. A growth of 2-3% for an emerging market is like recession in advanced countries. Now, this is becoming common knowledge, but I was the first one to say this because there is a different way of looking at it. We are very happy that India found, finally, the possibility of growing rapidly. And we were embarrassed that a non-democratic country was growing, and India, the greatest democracy, the largest democracy in the world, was not. We are therefore delighted that India is now found a way to grow rapidly year in and year out. Russia, of course, it is what it is. I never was convinced Russia's growth was based on the exports of primary commodities, gas, petroleum, and so on. But the real shock is Brazil. Real shock for the markets. Because Brazil, 30 years ago, was supposed to be the great economy or one of the leading countries in economics. And I said, we wish Brazilian well. But all the things, population, resources, dynamicism, existed before, and nothing happened. You have to explain to me why it should happen now. And of course, it's not happening. Brazil now is in a deep, deep recession. It will be in recession next year also. The other one of the BRICS, even though it doesn't belong there, South Africa became a BRIC because China politically wanted to have a foothold in Africa as the country on which to begin the invasion, technically, of Africa. So it doesn't belong because then we should have Turkey, then we should have other major, more important and bigger countries. But South Africa, you see, 30 years ago, I thought two countries would be interesting, South Africa and China, for different reasons. And so I am honorary professor at the University of Pretoria, consultant to the Reserve Bank, the central bank, and so on. So I know South Africa, and all I can say is that rate of growth really is not even half of the potential of South Africa. And what is incredible, that inequalities in South Africa today is greater than 20 years ago. Certainly no one wants to go back to that awful system of apartheid, but now they cannot blame apartheid, okay? There is so much crime and so much corruption. Now, no country has a monopoly on crime and corruption. However, when it reaches a certain level, over a certain threshold, nothing you do to increase growth will work. And so this is exactly what we have. It's not panned out. So we see that even by now, by last year, the rate of growth was declining in the world. The blue is 2011, the red 2012, the yellow 2013, and the green 2014 in advanced countries and in emerging markets. Growth is slowing. And the reason for saying this is not to look at the past, it's to look at the future, where we are coming from and why, in order to anticipate what to expect. We also know that advanced countries did everything possible from the point of view of monetary and fiscal policy. The left figure indicates nominal rates by central banks. Notice we are practically a zero rate. And you can see the red rate is where Trichet increased interest rates in April and July 2011. But now all the three major areas, the Euro area, Japan, and the United States, among advanced countries, have practically zero rate. The figure What happened? You see, this is what I hate with these technologies that don't... Okay, and we have to go to PowerPoint. Grazie. So the last figure on the right is the real rate of interest, the nominal rate minus the rate of inflation. And though the rate of inflation is low, the real rates are negative. Now, this is dangerous. Negative real rates, in Switzerland, of course, it's even more than indicated. The negative real rates lead in businesses in search for returns to undertake excessively risky investments, and this may be the creation of a new bubble. In the center, it is the quantitative easing. The blue line is, of course, Japan, and remember this for when we discuss what Stiglitz was suggesting we should do in order to restart growth. The yellow is the United States, and the red, not seeing the quantitative easing of the European Central Bank, is shooting up now. So we've done everything possible and more from a monetary point of view. We also had deficit, budget deficits. Again, we will see the relationship of this to what Stiglitz said. The United States, but of course, it does not have to respond to Maastricht. However, the budget deficit as a percentage of GDP reached 13% in 2009 and still 3.8%. In the euro area is more contained, now, I'm not speaking for Italy, but I do not know why the central bank calls on Italy when it's 2.9 and it's the possibility that it goes to 3%. Why doesn't it call on Spain with 4.4%? Why doesn't it call on France first, where the budget, the deficits have been far in excess? But look at the debt. The United States is no longer a virtual country. When Obama became president, the debt was 64% of GDP, and it is now 104%. And Stiglitz suggests that the way to grow, and we'll comment on that, is to spend even more, You see, if you have pneumonia, you use antibiotics. You have recession, you use expansionary fiscal and monetary policies. But we are not in a recession. We are slow growth. And slow growth is like a circulatory problem. You cannot use the antibiotics, you cannot use monetary policies to stimulate growth. It's, yes, you can give it, but it will not, the multiplier will be 1. We are spending future expenditures to stimulate growth today, and then when interest rates will rise, 1 percentage point, each 1 percentage point of increase in the interest rate in the United States will cause $100 billion more in interest payments. And one could say, well, the problem we have now, yes, but we don't want to become like Greece, and we will see. What is it that Stiglitz is suggesting? That we spend more. We have to spend more in order to grow. And what to spend on? Spend on infrastructures. Well, Japan has done exactly that. Has spent on infrastructures, and look at the debt of Japan, 246%. So we are already seeing, says, well, but we will do it better. But Japan spent its debt, which of course is held by Japanese, so it doesn't create the other problem of other countries whose a great portion of the debt being held by foreigners. Nevertheless, Japan has done exactly what many people indicate should be done today. Spend more in order to grow. But growth is a long-term problem, is a long-term aspect. It's not a cyclical problem, and you cannot correct lack of growth. There are other reasons why we do not grow. And it's not even inequality. You see, inequality, yes, of course it leads to less expenditures, but inequalities like slow growth themselves are a function of something else. There is something else. The increase in inequality is like having a headache and you take an aspirin. You are you're trying to correct the symptom, not the underlying forces. Of course, Stiglitz did say that we need to restructure the economy. Bluntly, growth depends on improvements in productivity. It's a real sector. You cannot buy artificially long-term growth. We will talk about that. The Eurozone has not been indebted as much, and the United Kingdom and Canada the same as the United States. So we've done monetary and fiscal policies more than we expected to do. And so now, at this point, we would have question 2. We skipped question 1, unfortunately. Could you do question 2? Or we can go to question 1 first and then question 2, okay? So we can do question 1, which was after this. Blocked again. Sì, andiamo a domanda 1, poi torniamo. Sì, benissimo. So, somebody is managing the question? Yes. And you are supposed to vote to see how you feel. Sì, domanda 1. Cominciamo a votare? Sì. So the results are, where do you think the EU is likely, according to your vote, is likely to be the one where growth will be higher in the next 3 years than in the past 3 years. Perhaps Europe cannot do as bad as it did in the last 3 years. So so the United States are 31% who feel that the United States will grow faster in the next 3 years than in the previous 3 years, but the majority indicate that it's Europe that will grow faster in the next 3 years than in the past 3 years. And then, of course, the China is less. Okay, so we go on to the second question. This question, of course, goes to the heart. Should we have done more in terms of monetary and fiscal policy? I expressed my view. Stiglitz expressed his. We want to know your view. You spoke, it is other policies. We cannot grow by cyclical policies when the problem or the difficulty is structural. So I'm glad that we want to know, because you are I always listen to people in the market. You are closer to the economy. We can look at it from behind, but we have to interpret also your view, or keeping in mind your views, because your views reflect what you will do, and therefore have an influence on what will happen. So we see that almost half of you feel that other policies, other than greater expansionary and fiscal policies, would be needed for growth. Now we can go back to, okay? Now the question is, slow recovery in the United States. As I've said, in Europe and Japan, people would be happy to grow at the rate of the United States, but the recovery in the United States has been slow, and the reason we can see it from this figure. Look at the black line. That's the long-term trend line. Then there is a dip in the real growth, and that's the recession. Now, in every recession in the past, in the United States, in the past 3 or 4 recessions, the next 2 years, the United States grew very rapidly, 4, 5, 6% growth rate, real growth rate, to bring us back to the long-run trend. This is the first time that growth resumed, but we lost $1 trillion of GDP that it was never recuperated. Now people say, as Stiglitz did say, that we're doing well. We're not doing well, because even though the real rate of unemployment, the official rate is 5%, 4 percentage points of the labor force in the United States, discouraged by not finding a job, they left the market. They are so unemployed that they are permanently unemployed. Then Obama had the health care, as we will see, and Obama health care, everyone has the right to have health care, but the firms will pay for health care only if they hire for more than 30 hours. And it's not that firms do not have any social conscience, but they respond to incentives. So 2/3 of the new jobs today in the United States are part-time, when before 2007, not even 1/3 of the new jobs were part-time. In any event, we see why growth is slow. Today, the United States, or by April of last year, it took 6 years to return to the same number of employed people. In the meantime, the labor force increased by 7 million, and only 2 of those 7 million have found jobs. We are 4 million jobs below where we should be at this time. And why has the United States not grown rapidly? Because of low productivity growth, as we will see, the highest tax rates on foreign profits, outsourcing, and economic uncertainties and overregulation. Look at the the growth of productivity. The average decade-long, the average yearly growth in each decade. In the year 2000, it was 2.7%. Even in the lowest rate of growth of productivity, it was 1.6%. For the past 5, including this year, it's 0.7. So one reason, a major reason for lack of growth is that productivity is not growing. Of course, there are studies and reasons why this productivity is not growing, which is a major problem, the major reason why we do not grow in the United States and Europe. Of course, we don't have time for that, another time, another place, and of course, we will have the round table tomorrow. Then the highest tax rate, what happened? It disappeared. The average tax rate, it was there originally, now it may appear as we talk, but the United States taxes profits at 39%, Japan 37%, Germany 34%, France and so on. The United States, the highest corporate tax rate than the G7 countries. And so what happens is that the trillions of dollars that the United States corporations earn abroad, there is no incentive to bring them back, because they have to pay in Ireland 12.5% on foreign profits. Now, it doesn't mean that US corporations should bring back all of the profits, but now they are practically very, very little. It's a non-level playing field. This is a second reason why the United States doesn't grow. There's not enough investments coming back according to market reasons, except that they want to avoid paying the huge taxes. Then there is outsourcing. Well, outsourcing, of course, we know. We get cheaper goods, but no jobs. But there are ways and ways to outsource. And to indicate that, look at innovations. Who created the iPad? The United States. How many iPads produced? Over 300 million. How many of them produced in the United States? 0. All of them come from China. Of course, we have to say immediately that 40, 50, 60% of parts and components of the iPad exported from China come from other countries. But now we come to the heart of the matter. Corporations must understand that you outsource, but there is an intelligent way to outsource. There is a theory that postulates how we should outsource. We cannot outsource our core competencies. Otherwise, we have nothing left. The next iPad will come from China, not from the United States. So corporations want to minimize costs. Of course, they have to outsource. They have to scrutinize or look at the entire world to see what parts and components are made better and cheaper. And if they don't take advantage of that, they will lose first the international market and then lose their own markets. But if they outsource the core competency, they lose everything. Notice, for example, Airbus and Boeing. They hate each other. Fine, but there is a common interest. And also there is a rule of the World Trade Organization. The rule is very specific, and China has been signatory. You cannot force me to give you my technology in exchange for allowing me to sell to you. So I do not understand why China is allowed to operate outside the rules that everyone else has to. So the point is, it is our fault, not China's. It is our fault for allowing. So we outsource in a stupid way. We give our core competency. We allow them to play us one against the other. Strategic thing, a strategic game means nothing. I don't know why we study it. And there is rules and regulations that we must follow. And if people or nations don't follow, we can call them to account to follow. But that's another. And this is the trade. Now, there is no reason that trade should be balanced bilaterally. But when a country is responsible for 90% of the trade, or 50, 60% of the trade deficit of another country, something is wrong. These are the monthly deficits. The blues are the exports of the United States to China, and the red are the exports of China to the United States. And this is Europe. World corporations dealing with China do not compete with the Chinese corporations, compete with the government of China. I become an enemy of China saying these things, but this is the truth. They cannot, if I'm wrong, I ought to know. So uncertainty. So now, Obama, America is one of the greatest countries. The father of Obama could not enter a restaurant. because he was black, and the son becomes president. I voted for Obama. I thought he understood more economics than he does. And he has never been in a corporation. You are in corporations. What is the worst thing you can do to a corporation is uncertainty. When there is uncertainty, according to the tax rates, the cost of the health reform, the corporation stops, waits, does not invest. That is the worst thing that we can do. Then the short-run horizon of these policies. A firm will not respond to policies which have a horizon of 6 months or a year. At least have to be 5, 10 years to respond. And then over-regulation. Now, Stiglitz said truly that small banks in the United States did not, they were very harmed when the help to the banking sector was given. Well, it was this Dodd-Frank financial reform that created that. Small banks, small corporations are harmed so much by the cost of satisfying this reform that it's hampering. In other words, to do everything that the Dodd-Frank financial reform requires, each year they have to be self-studied or evaluated by outside corporations. The cost is practically the same for a small corporation or a large corporation. To satisfy the Dodd-Frank financial reform, they have to spend over $1 million. For a big corporation, that's nothing. For a small corporation, small bank, this is very detrimental. So the result is firms do not invest, and we do not grow or grow less than necessary. The top line was the growth trend before the crisis. The second line, dashed line, was the growth trend at the beginning of the recession, but we have actual growth less than that today, as we saw earlier. I think this falls asleep once in a while when I don't move quickly enough. Next. Okay? Now we go to Europe. I say, Europe has 2 problems. 2, not 1. And often they are talked as if they are the same. One is the problem of the euro itself. The other is the problem of the European Union, independent of the euro problem. What is the problem? Well, in the peripheral countries in trouble, they have overborrowed. They have overborrowed, and now they cannot sustain their borrowing. But I say, even if by miracle, and I don't believe in miracles, even if by miracle the excessive overborrowing of the peripheral countries disappeared, these countries would still be in trouble because they cannot compete, period. The other problem is the European Union just doesn't grow. Look at the graph. The vertical line before is before the euro. The higher rates on the left of that line are the interest rates paid on the national debt of the peripheral countries in trouble. They had to pay higher rates than Germany, the lowest of those rates. And so they were limited in what they could borrow. Then the euro came, and financial markets believed that because of the common currency, that holding a Greek debt was no more risky than holding a German debt. And so interest rates in the peripheral countries became the same or nearly the same to those in Germany. The interest rates declined very much. They overborrowed. Then Lehman Brothers came 2008, the second vertical line. Financial markets realized that holding a Greek, Italian, Spanish debt was more dangerous than holding a German debt. Interest rates increased. And so whatever the overborrowing that was sustainable at a low rate was no longer sustainable. But even if that disappeared, even if Greece, we eliminated all the excessive debt of Greece, this is the unit cost of labor as an index of international competitiveness. The black line, since 2000, the unit cost of labor in Germany has increased about 5%. The other countries by 30–40%. So that's one problem. The other problem is that Europe doesn't grow. Starting in 2008, the vertical line on your left is the growth of real GDP in the United States, and the blue line is Europe. That's total GDP. The right figure is the growth of per capita GDP in the United States and in the euro area. But the problem in Europe did not start with the crisis. It comes from far away. If from 1980, the blue line is the growth in the United States, the green line is the growth in Europe. And as you see, the pre-crisis structural gap was increasing over time, and then when the crisis came, it increased even more. So Europe has a serious problem. Do you remember Lisbon, the agenda of Lisbon in the year 2000? In 10 years, in 2010, the European Union will become the most dynamic and rapidly growing country in the world in relation to other advanced countries. When they realized that the gap became even more, now we have Europe to 2020 to make Europe the best area in which to invest and to innovate. Nothing is happening. And so the problem is not that we're not stimulating. The problem is elsewhere. You see, first we look at at the growth differential. Then we have to go upstream to see what is the cause of growth. We want to spend more? Okay, let's be like Japan. So we can do it better. Japan too spent 250% national debt, 250% of GDP, doing exactly what Stiglitz and other people say should be done. Invest in infrastructures. That's what Japan did. And Japan is not a non-technical economy or no innovations and so on. And still, that we hope. I hope they are right, but I don't think that they will be right. What do we want in the United States? To go to 200% debt to GDP? Is that we buy growth? We buy temporary growth. We are spending upfront what we will spend tomorrow. The multiplier. You see, the fiscal policy works when you spend $100 today, which you have to repay in the future. But that stimulates a growth of 140%. 1.42. But the multiplier is 1. We spend upfront what we will have to pay afterwards, and I don't know that it will stimulate growth. This is not a question I'm right and he's wrong and so on, but we will see. And we have some experience as to what happened. We are not growing, not because we are not spending. We can spend, but then we have to repay. And what stimulus? Growth is a real sector. Growth depends on the growth of productivity and other things that increase productivity, not artificial. Otherwise, it would be fun. We keep spending. And I remember Aldo Moro in Italy says the national debt, that is never repaid. Oh, really? Well, we see what's happening to Greece. Okay? So now we go to China. Look at the left figure. That's the rates of growth. The official rates of growth have declined and they become 7%. The second, next to it, is the growth of industrial production. The growth of industrial production has declined. Then net capital flows to China. Before, except in 2008, 2009, there was a capital outflow, but now there are huge capital outflows from China. And the yellow, the last one, is the imports, the growth of imports, which before were very high, then they became practically zero, and now they are negative. That is, the growth is declined so much. Now, finally, we are coming. What is the real rate of growth of China? Well, the left figure is the official rate, and the other 4 figures is different research institutions and businesses that indicate that the rate of growth, in fact, is more between 3.8 and 5% than 7%, and the comment that China needs a growth rate, and the government knows, of about 6% per year. I was instrumental in creating the top first or second valued MBA program in China. And until 5 years ago, the graduates of that program, each graduate had 3 or 4 jobs among which to choose. Now there are 3 or 4 graduates of that same program that are competing for the same job. And they live in 1-room quarters hoping to get that job. And the government knows that these are not peaceful people. They spent money, they sacrificed in the expectations of getting a benefit. And if that benefit doesn't come, they know that that is not a very peaceful situation. Now we say China is restructuring. Notice the blue bars are the consumption. China is trying to restructure away from heavy investments and export toward domestic production. But the consumptions is not increasing. Not increasing, and Chinese save very much because Chinese people have to do what government does for us in advanced countries. They have to save for old age pension, they have to save for unemployment, they have to save for education. And so they are not going to spend very much as the government is hoping. And so if the government thinks that it can continue to grow by restructuring away from heavy investments, which lead to diminishing returns when you invest, we know the dreadful diminishing returns, but people are not taking the bait. They are not spending more, which is necessary in order for China to continue even the reduced growth rate that we are estimating. And then we have the Chinese devalue the currency, but frankly, let's make a big deal, 2%, 4%. China is in trouble, so the currency can devalue. And the way they devalue, look at the green band. They increased the band of fluctuation, and so the currency found immediately to the bottom of that allowed band of fluctuation. But we should not make much of it. The country is in some economic difficulty, and so devaluing or allowing the currency to depreciate is not wrong. Also, they used powerful expansionary policy. The lending rate, which in that figure is 4.5%, last Thursday it was reduced to 2.75%. So they've done monetary policy, and the reserve ratio for large banks also has declined. So they have done policies, and this is the debt. The second part disappeared. There is another part to that figure. But look at the national debt of China. Total debt, not just the government debt. It was 160% of GDP in 2005 until 2007. Now it's 240%. China also has done expansionary, not only officially, but also businesses and individuals have borrowed more. So China faces a debt problem also. They have the resources to deal with it, but they have done expansionary fiscal and monetary policy very powerfully. So what happened to the rest of the world? We conclude. What happened to the rest of the world when China started to import less primary commodities? This led to a slowdown in emerging market economies, which suffered capital outflows, competitive devaluations, and difficulty in servicing their large dollar debt. And slower growth in China and emerging markets, of course, slows growth in advanced countries, which feeds back. We are an interdependent world to advanced countries. So we are in difficulty, and all it takes, and some other unexpected event, for example, that we realize that China's growth officially is 4% or 3%, or that other emerging markets become like Japan, Brazil and Russia, or that Europe falls back into recession, or the United States growth collapses with the appreciation of the dollar and the increase in interest rates that could trigger a new global financial crisis. You see, the problem of markets intuitively, it's not the question that the Fed will increase rates by 1/4%. But that signals a future increase. So it's not the 1/4%. The United States Fed is trying to reacquire the power to be able to do monetary policy. So they need at least a rate of interest of 1.5%, 2%. And what is not known in Europe is that this has to be achieved before the next year presidential election in November. During presidential election, they cannot increase interest rates. And if the increase was 0.5%, that's no weapon against the possibility of returning in a crisis. What would we do if we return in recessions? We've already used all of our ammunitions. Monetary policy, QE, expense, budget deficits. How much more can we do if we return? So the Fed is trying, and of course this helps Switzerland because the euro is going to go to parity with the dollar. QE of Draghi is going to come. So there will be a divergence in the monetary policies across the Atlantic, and so it gives some relief to Switzerland currency, which is very strong and, of course, affecting business. If the United States was moving in the same direction in Europe, more troubles. It's very difficult to have an independent, successful policy when one is in an oasis of the euro and the dollar. And it's very difficult even for a large country to do an independent monetary policy in a globalized world, and even more so for Switzerland, which is not, a large country. But this is primary commodities. Look at the top two, the red, and I'm coming to the end, the red and the blue. Those are food and beverages and agricultural materials. So since 2012, they have declined about 10-15%. But look at the green and the turquoise line, which is metal and fuels, as we know. They have collapsed. Today, look at that figure. Those round circles or oval circles indicate that the price of primary commodities today is exactly the same in the 1990s. So Stiglitz was correct in saying that they did not take advantage of this boom in primary commodity prices. They didn't do anything. You see, when they earned a lot of money, there was no reason to restructure their economies away from primary commodities. And when the commodities, the price falls, they don't have the resources to restructure. So it is a lost opportunity. And this is corporate market, emerging markets corporate debt, those bars, the green bars. And on the right is total return on emerging markets corporate bonds. Look, practically zero return. No wonder we are not buying, we're not investing. The top figure is flows, net flows of capital to emerging markets. Look, at the end of 2014, and until now in 2015, capital outflows, which is terrible for these countries. And the bottom figure is the loss of reserves, from plus 500 a year to minus 500. $1 trillion loss in reserves by emerging markets. And these are exchange rates. The top two are the dollar and the Chinese RMB. The green one is the euro, returned to the level of 2012. And the bottom is the Japanese currency, the Brazilian, and the Russian. Really heavy depreciation. So emerging markets are facing capital outflows, increased indebtedness, and the heavily depreciating currencies. And these even more, the depreciation of currencies during this year for the Russian ruble, the South African rand, the Turkish lira, and the Brazilian real. And so we come to question 3 and 4 before our conclusion. Please put on question 3. And we want to know from you, what do you think? What are the probability that emerging markets are facing a crisis in the next 2 or 3 years? You say, but the experts are those who speak. But the experts, you are in the market, you are in the field, and it is important to know how you feel. What is the probability that? So, what do you think is the probability that emerging markets economies will face a recession in the next few years? So the major is 5 to 20%, the major results, and 20 to 50%. So we remember that your opinion reflects what you will do on the basis of what you believe. So the probability between 5 and 50%, 5 of course is very little, 1/20th, but 50% is half. So between the two, we have 75, 74% probability that we will be in some kind of a crisis in emerging markets. I always say, when we come to these meetings, if we leave these meetings without knowing something more, deeper, better, Can you imagine the economic waste? We're not here to have the minuet dance of the Middle in the Middle Ages. We are here to try to understand but we want to know what is the opinion of the people in the market itself. And question 4 is, what do you think is the probability that we will face a new global financial crisis similar to the one that we faced in 2008? Well, the probability, thank God, optimism is always, if we have to make a mistake, it's better to make it slightly on the positive side than the negative side. So it is only about 1/20th or 1/5 of 100%, 51%, half of the people think that between 5 and 20%. So to conclude, the US is likely to grow more slowly than in the past. This is in the cards, at least. And Europe and Japan, even less. This is in accord to what Stiglitz and many people are saying. We hope to be wrong. But 2016 probably will not be much better than 2015, even though the IMF and all the ones doing forecasting always predict more growth in the future. But this future, when 2016 comes, we hope that we are wrong, and that the growth in emerging markets, slower growth, they are, if anything, the probability of higher growth in emerging markets may not be realized until after the middle of the year. Is the world facing a new bubble or crisis, or only a new normal of slower growth? Well, this will be examined in the panel tomorrow. We prepared the background, the situation from which we start, and we heard your opinion, which will affect also we on the other side who are not directly in the market. So I end at this point, and thank you very much. And we have few minutes for questions according to the organizer, if we do have. Thank you very much.